So how long will this tariff uncertainty last? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you have a question for me, I would love to invite you to go to the website, www.prudentmoney.com. At the top of the site, there's an Ask Prudent Money tab. Just click through and send your question in and we'll get you taken care of. If for some reason you haven't heard from us within 24 hours, make sure you give us a call. You can get the number on the website at prudentmoney.com. And make sure that we are in the process of, or make sure that we got your email. It's one of the frustrating things about email is that you just never know if someone is going to get the reply, and you never know if it's in spam or if it just disappeared in email space, wherever that is. But we definitely want to help you, and that's one of the best ways to do it is through the Prudent Money website. So just if you don't get an answer, once again, give us a call because we are answering those emails. That's all at the website, www.prudentmoney.com. Well, how long will this tariff uncertainty last? You know, it's interesting to watch investors and to watch a lot of your financial analysts on CNBC act as if we could just get rid of this tariff uncertainty. If we could just get a good visual as to what this looks like, what's going to be the end result, everything would be fine. The market would go up, except we have this up and down situation with stocks, which has earned a interesting name, which we'll get to here in just a second. But I think that the problem is very simply that President Trump is trying to take a process that is typically a very long process and cram it into 8 to 10 days in a couple of meetings here and there. He's trying to negotiate trade agreements, and listen to these statistics. For the United States, free trade agreements typically take about 18 months to negotiate and approximately 3.5 years to implement. Now, Trump is all about the record. He's all about the wins, and obviously he's not going to go through a process or take a process that takes that long. But I think, though, that you have to realize is that this is a big, important process that countries go through to make sure that you're not going to get free trade eliminated, but there's got to be a balance there, and there's got to be a balance between countries. This is where you have egos get in the way, you have pride get in the way, you have a lot of things that get in the way as they try to negotiate winners and losers. But really, what ends up happening at the end is that there is no winner or loser. Everybody's a winner, and that's what you have to get to, whether it's true or not. You have to be able to spin that story of winning and winning, and not winning and losing. That's the challenge, and that's politics, as you know. That is the challenge. So, what is the taco trade, and why should it concern you? Let's talk a little bit about the taco trade. And the taco trade is not anything I've made up. I'm just not meant to be disrespectful. It is just a phrase that they're talking about on Wall Street. The article starts, it was another week of policy pivots, back and forth trade headlines, and an economic data that did little to anchor investor expectations in the midst of the chaos. One phrase kept surfacing across Wall Street: the taco trade, an acronym for Trump always chickens out. It captures a growing belief among investors that the president talks tough on tariffs but rarely follows through. The assumption has fueled a market tailwind in recent months as traders bet on policy pivots. So, it's just like, why, and this is why you should understand what this means and why it's happening. It's like buying on the dip. You've heard that phrase, where the market seems to have gone down as far as it's going to go down. You're going to try to catch the bottom, buy on the dip, and get the ride up and get into the recovery of the stock market. And that is what they're doing they're loading up on stocks when the tariff news is good news, and then they're selling stocks when the tariff's bad news. So you got this constant yo-yo effect, a lot of volatility, but it's important as an investor, I think, in this marketplace to see that for what it is. It's just the direct result of negotiation and what goes into settling trade agreements, free trade agreements. So, however, if we're in a situation to where this gets really bad, we fall into a very deep recession, and you have other countries willing to go into a deep recession too, just as a way of negotiation, and then inflation runs away, then we've got a totally different situation on our hands. But I think that we've got to have we got to remember how President Trump negotiates, and I think that that's an important aspect of the whole process. Is that he is a home run ball hitter, so he's always going to go for the home run ball. Well, what happens when you always go for the home run ball? You strike out a lot, and that's the way he's been. He's hit some huge home runs, and I think he's banking on this being a huge home run. Lots of political risk that could blow up in his face. Of course, had he gone about this maybe a little bit of a different style that eliminated threats and name calling, he probably would be faring a lot better than he is. He could also take down the markets and the economy down. That's always a situation that is a possibility in this particular process. But, once you cross a particular line, and I don't think that we have done that, maybe we have done that as far from the standpoint of ego and pride goes, but once you cross a particular line, there is no easy way back. And I think you got to keep that in mind. So, these other countries have a choice to fight or to go along with Trump while burning as much time as possible. Do you really think that China is going to allow themselves to be bullied or lose face in the process? And that's a big one. I have a close friend of mine who used to do a lot of business in China, and it's all about are you going to lose face? And there's a lot of country pride there. So keep an eye on it. We'll talk a little bit more about it and keep you posted on it. But I do think to wrap it up, two issues to consider. The first one is it takes typically a normal free trade agreement process takes 18 months on an average to complete and 3.5 years to implement. So kind of keep all that in mind as the market goes all over the place. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. Well, is there any silver lining with the $36 trillion that we have in debt by our government? $36 trillion. I did the math. I think we're a couple of weeks away from hitting $37 trillion. We should have a party or something. But $36 trillion is a lot of debt. Remember, $1 trillion is a million millions. It's hard to get your head wrapped around that. But I think as an investor and a steward of what God has given to you to manage, you've got to start to understand what this whole interest rate thing is. And we talk about it a lot. And I want to go back through kind of the basics of it so we can keep this into perspective, especially sometimes it takes repetition for people to really understand. And if you're listening to my program, I want you to be very well understood on what all this means. Let's start with the basics of interest rates. And to do so, you have to start with the 10-year Treasury bond. And the 10-year Treasury bond is a bond that you would buy from the government for 10 years. You buy the bond, they pay you interest, they use the money, then at the end of the 10-year time period, they pay you back the money. It's highly unlikely that the government is going to default on that 10-year Treasury bond. But the 10-year Treasury bond market is $29 trillion that make up this market size. So if you can imagine, because we've talked about this on several occasions, what would happen if we were to get into a bond crisis in the bond market? And that's a $29 trillion market. I don't have in front of me what the stock market is, but I believe it's only 3 or 4 trillion more. So you can see when things get a little bit hectic and you see a crisis appear, there's a lot of money that is at stake when you look at it. $29 trillion in the 10-year bond market, Treasury bond market, is an amazing figure. But what does all this mean? Where is it going? What's the inverse relationship? All this and more to come. Hey, this is Bob Brooks. You are listening to the Prudent Money Radio Show. Stick around. We'll be right back. Hi, my name is Bob Brooks, host of the Prudent Money Radio Show. So let me ask you a question. Do you know your numbers? Now, which numbers are those? They are your retirement numbers. That set of numbers is the single most important planning numbers you can know. Yet the majority of Americans don't even know them. Prudent Money Financial Services, sponsor of the Prudent Money Radio Show, specializes in figuring out those numbers and creating a game plan to make sure you're on the right track. Listen to the Prudent Money Radio Show weekdays at 3 p.m. on Bible School Radio 91.3.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. You know the drill. If you got a question for me, go to the website, www.prudentmoney.com. And there is a section at the top that says Ask Prudent Money. Just click through the link and get us the question. We'll get you the answer. That's all at the website, www.prudentmoney.com. So we're talking about the 10-year Treasury bond. And all you have to do is to look it up. You can go into cnbc.com. You can look it up to see what it's done for the day. Well, what we're looking for is the interest rate that is attached to the 10-year Treasury bond. Is it going up or is it going down? We want to see it go down. That would be the best situation, but it's not. It's going up and continuing to stubbornly go up. And that is the problem that can cause a lot of other problems. And when they say the interest rate or the yield is going up, just in your head, think interest rate. And if it gets over, as it continues to go up, so does the mortgage rates go up, and the consumer-based interest rates for buying a car, for credit cards, but credit cards are such kind of a joke because they're so high to begin with, but that they are in effect aligned with the Treasury bond, 10-year Treasury bond as well. So the Federal Reserve Board, who sets interest rate policy, who says this is where interest rates should be, has no control over the 10-year Treasury bond. And so the 10-year Treasury bond is controlled by investors. And so it's whether they follow the Fed or not, and they have not really been following the Fed, which is once again which is a risk. However, saying all that, putting all that aside, I think that the reason you're seeing interest rates go up is because you're seeing investors demand more and higher interest rates on the 10-year bond than the 10-year bond is paying because of risk. You got to take a step back and realize that the Treasury bond or Treasury investments that invest money into the government of the United States is supposed to be safe. It's supposed to be backed by the U.S. government, and you shouldn't have any risk at all. It should be risk-free. Well, investors are seeing that there is risk, and they don't like it, and so they're demanding a higher rate of return on their money. I think that's really what's going on. But here is the silver lining. Obviously, nobody likes mortgage rates going up. Nobody likes car loans going up, or any interest-bearing loan that as a consumer that you face. But there is a silver lining, and this is something that I think people are missing out on, and I think it's something that you need to make sure that you have a good understanding, because you're probably missing out on extra interest, and that is the liquidity and the perceived safety of the money market accounts. Money market accounts are investment products typically offered by brokerage firms. You're not going to really see them in banks. You might where banks and brokerage houses have combined, but your typical bank, you're not going to really see these kind of high yield money markets. They're not insured by the FDIC. However, investments held in brokerage accounts, including money market funds, may be protected by the Securities Investor Protection Corporation up to certain limits. Important to note that the SIPC coverage protects against a loss of securities in the event of a brokerage firm's failure, but it does not protect against losses from market fluctuations. But if something happened to the money market industry, we'll call it, and there were severe losses, because every money market, when you put $1 in, you have you have one share. You put $1,000 in, you have 1,000 shares. Every dollar is every share of a money market account is $1. And if what you're looking for what would happen if the dollar, if they broke the buck. So in other words, if the dollar went down per share to 90 cents per share, that would be a pretty horrific situation. In fact, something like that did happen during the financial crisis. I believe it was Ameriprise was holding that particular money market. They broke the buck. They went under $1 a share, and they had to be bailed out by the government, and which started really a number of bailouts that we're still trying to get our arms around today. But needless to say, I mean, things would have to get extremely, extremely bad for that to happen. In fact, I often wonder if things got that bad to where money markets were losing money, would the FDIC be able to insure all the banks? But this is a critical moment for the government, is to make sure that the money markets are protected, to make sure that the FDIC insured funds are protected, because any kind of loss would be horrific and devastating on the economy and on the country, because that's the one thing we count on. So this is, the money markets are protected by the Securities Investor Protection Program Corporation, but they're only protected in the event of a brokerage firm's failure, but it does not protect against market fluctuations. So what kind of return are we looking at, are we talking about when discussing money market mutual funds? Well, we're looking at, and it just depends. I went to the Fidelity website earlier and just did a little bit of a check to see where interest rates were, and they're fluctuating at Fidelity depending on whatever fund you use for your safe money, and safe with an asterisk and a disclaimer, as we've talked about. But it's somewhere between 4 and 5%. So if you've got $100,000 sitting in the bank, drawing 1.5% or something that's near that, and you're missing out on 4 to 5%, and it's been 4 to 5% for a very, very long time. And I get it. There's some people who don't want to chance it. They feel there's a risk there, and there definitely is a risk there. I mean, I think it's a low probability risk, but there is always risk in any type of situation like that. But I would say there's hundreds and thousands of people who are missing out significantly on interest, and something that you want to check out. The other thing too that's benefited from what we call the silver lining of $36 trillion in debt is fixed annuities. If you asked me what the best guaranteed fixed rate, can't lose any money, let me walk that back. In an extreme situation, you could lose money, but it would have to be pretty extreme, is the fixed annuity. And the fixed annuities, just so that you know, work and operate just like a CD, except for the term is a lot longer. And that's something that I particularly like, because I don't think that necessarily interest rates are going to go way up, but I don't think they're going to go down. So I think that the longer you have locked in, the better off you can be. But you could lock it in 5.3, 5.6%, depending on the company that you go to. And, something else you want to realize is that all companies are not created equal. Some are bigger than others. Some are more highly rated. So that's kind of where you take your risk, is the ratings and the statistics and the interest rate they're paying. And there's 10, 15 companies out there that are paying very, very competitive interest rates, and with the guarantee of no losses, which is pretty nice. Bottom line is, you want to make sure that you are taking advantage of everything that you can possibly take advantage of. And higher money market rates are definitely one of those things. And the other thing too is that your Fidelities of the world and your Charles Schwabs of the world, they're trying to get into a situation where they can lower those money market rates, really for no good reason. So even if you have opened up an account at a Fidelity or Charles Schwab or maybe even Vanguard and utilized their interest rates, you do have to realize that they do change. And if you're starting to see a significant change, you are definitely going to want to ask some questions, and it might mean that you want to move someplace else and get a different money market type product, so that you can get the full amount of the return that you have coming to you. And they look at everything from a 7-day yield. So that's what that represents, because you'll see 7-day yield by the money market rate. That's if you were to hold it and for an entire year, that's what it would have returned if all things stayed consistent and constant. So that's where you get your information on it, and of course, it's always on the websites of all your major brokerage companies. Hey, this is Bob Brooks. If you got a question for me, please go to the website at www.prudentmoney.com. Just send it in and we'll get you taken care of, all at prudentmoney.com. We are all out of time today until we do meet again.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.